November 9th, 1494. Inside Florence, Giovanni Tornabuoni is 64 years old. For 3 decades, he has overseen the Rome branch of the Medici Bank. During those years, he managed papal finances, arranged funding for cardinals, transferred wealth on behalf of kings, and witnessed the Medici family become identified with European finance in a way unmatched before or afterward. On this day, he prepares a letter for Piero de' Medici, the son of Lorenzo de' Medici. The message delivers devastating news with the restraint of a man attempting to remain calm while reporting disaster. The bank is finished. Charles VIII of France crossed the Alps 6 weeks earlier. The political framework across Italy that had sustained the Medici network of sovereign connections is now unraveling branch after branch. The Bruges branch has already fallen. Lyon has fallen as well. The London office never recovered from loans extended to Edward IV, debts that were never repaid. The Rome branch is on the verge of confiscation. Piero de' Medici has been driven out of Florence by citizens who hold the family responsible for everything from the French invasion to the cost of bread. Tornabuoni does not claim that poor decisions destroyed the institution. Instead, he explains that the bank had become so deeply embedded in the machinery of European finance that, once political conditions changed, there was no safe place left to withdraw. The Medici had done more than lend money to rulers. They had become part of the financial infrastructure upon which rulers depended, and when infrastructure breaks down, the collapse is never quiet. 530 years later, there is an institution that European central bankers, American regulators, and many figures on Wall Street privately recognize as occupying a remarkably similar structural position. Its identity is no secret. What remains largely unspoken is the mechanism behind that comparison. The rise of the Medici Bank is commonly presented as a story of Renaissance brilliance. That description is accurate. Its downfall, however, is often framed as little more than political bad luck. That interpretation greatly understates a structural weakness that existed from the beginning. The Medici Bank operated through a holding company model, an unusual arrangement for its time. The parent organization in Florence supervised a network of semi-autonomous branches located in London, Bruges, Lyon, Venice, Rome, Geneva, and Milan. Every branch maintained its own manager, its own capital structure, and its own profit and loss records. Managers were rewarded for generating earnings and were granted significant freedom to pursue opportunities they considered profitable within their regions. During the expansion years, this approach worked exceptionally well. Local executives understood local conditions. They could react more quickly and assess risks more effectively than any highly centralized system. By delegating authority in this way, the Medici built the most advanced financial network in the world. Yet a problem was quietly developing over many decades. The incentive structure encouraged managers to pursue transactions rather than exercise caution. Profits remained with the branch. Catastrophic losses ultimately became the responsibility of the parent institution. Edward IV of England never repaid the $16,000 owed to the London branch. Charles of Burgundy owed even more to the Bruges operation. At the time, those sovereign loans appeared to be sensible commercial arrangements. They were backed by revenue streams and political relationships that seemed stable and reliable. In reality, they represented concentrated wagers on the survival of particular political systems. When those systems changed, the losses flowed directly back to the parent bank. By the 1480s, the Medici Bank remained operational in a technical sense, but its structure had become hollow. Its strongest branches still generated profits. Its weakest branches carried loans that would never be recovered. The parent company stood behind all of those obligations. At the same time, the institution had become so central to the European financial order that no one, including the Medici themselves, possessed a complete understanding of the total exposure. The French invasion did not create the collapse of the bank. The French invasion did not create the weakness inside the Medici Bank. It merely removed the final layer of protection that had concealed how fragile the structure had already become. Jpmorgan Chase holds $4 trillion in assets. It stands as the largest bank in the United States and ranks among the 5 biggest financial institutions on the planet. Those figures are public and widely recognized. The numbers that receive less attention are the ones that describe its structural position within the financial system. Jpmorgan's notional derivatives exposure, representing the face value of derivative contracts it owns or has issued, is approximately $58 trillion. Placed in perspective, that amount exceeds the gross domestic product of the entire world. Notional exposure is not equivalent to capital actually at risk. A large share of those contracts offsets other positions, leaving net exposure far smaller than the headline figure. However, the calculation of net exposure depends on counterparties fulfilling their obligations at the same time and on correlations behaving according to established models. During a genuine crisis, neither condition functions perfectly. Even more revealing than the derivatives portfolio is the history of emergency acquisitions. In March 2008, Jpmorgan purchased Bear Stearns through a weekend rescue arranged by the Federal Reserve. The acquisition price was $2 per share for a company that had been valued at $170 per share only 10 days earlier. To facilitate the transaction, the Federal Reserve provided a $30 billion guarantee covering Bear Stearns' most troubled assets. In May 2023, Jpmorgan acquired First Republic Bank. That event marked the second largest bank failure in American history. The transaction was supported by the FDIC and delivered First Republic's deposits, along with most of its loan portfolio, to Jpmorgan at a substantial discount compared with market value. 2 emergency acquisitions occurred within 15 years. Both involved direct participation or organization by American financial regulators. Both resulted in Jpmorgan becoming larger after another institution collapsed. This is the crucial point. The pattern created by these acquisitions is not one of predatory growth. Instead, it reflects the same structural force that made the Medici Bank indispensable and eventually impossible to rescue. An institution becomes so essential to the operation of the financial system that regulators cannot permit its failure. As a result, every period of stress makes that institution even larger. Each rescue increases concentration. Greater concentration raises systemic importance. As systemic importance grows, the institution becomes more difficult to regulate, more difficult to limit, and far more difficult to save if it encounters trouble itself. Jpmorgan is not simply too big to fail. It has reached a scale where failure becomes almost unthinkable within the system. This is where the comparison with the Medici becomes most striking. The issue centers on incentives at the branch manager level. Managers within the Medici network acted rationally according to the rewards placed before them. Their compensation structure encouraged transactions and discouraged the kind of caution that might have prevented certain commitments. Loans to sovereign rulers appeared attractive in the near term, even when long-term repayment remained uncertain. The manager who approved the loan benefited while serving in that position. The institution carrying the ultimate risks was the parent organization, which might absorb losses years later under entirely different leadership. Jpmorgan's trading operations, investment banking units, mortgage origination businesses, and derivatives activities are overseen by individuals whose compensation is heavily linked to yearly performance. The time horizon affecting traders and bankers personally is generally shorter than the period required for systemic risks to emerge. This reality became highly visible in 2012. A trading position within the London office, controlled by a trader known as the London Whale, accumulated losses totaling $6.2 billion. The exposure expanded to that level before senior management possessed a complete understanding of the aggregate risk involved. The position was accumulated gradually over a period of months. A trading desk pursued returns while remaining within its measured risk limits. The models guiding those decisions accurately described ordinary market environments. Yet when unusual conditions finally appeared, those same models proved disastrously inaccurate. The pattern sounds familiar. Local managers, individual incentives, centralized responsibility, losses hidden from view until they could no longer remain hidden. Jpmorgan absorbed the London Whale losses using its own capital resources, and the institution continued operating. What the event revealed was not simply that Jpmorgan was competently managed, although by comparison with many peers it was. What it showed was something else. The structural challenge faced by the Medici during the 1470s, decentralized decision-making combined with concentrated systemic liability, has not been eliminated. It has only been managed. And managed risks often become severe when external conditions shift more rapidly than leadership can adapt. This extends far beyond Jpmorgan. It extends beyond banking itself. The collapse of the Medici Bank did not only bring down a single organization, it interrupted the broader framework of European commercial finance, at a time when that framework functioned as the economic nervous system of the continent. Merchants, with no connection to Medici lending, suddenly found trade financing unavailable. The Vatican's money transfer network, administered throughout Europe by the Medici, required years to rebuild under new oversight. Cities whose tax collection structures depended upon Medici clearing operations were forced to reconstruct those arrangements from the ground up. Jpmorgan is not the Medici Bank. It is larger. It operates under greater regulation. It functions within a financial architecture supported by explicit government backstops that never existed for the Medici. Even so, it performs roles that are structurally similar. It serves as one of the primary dealers in the United States Treasury market. That market must process $9 trillion in refinancing during 2025. It is also a major counterparty in interest rate swaps used by corporations and municipalities around the world to manage borrowing expenses. Its correspondent banking network reaches financial systems across more than 100 countries. If the institution were to fail, the consequences would not stop with Jpmorgan shareholders. The issue is not that Jpmorgan is poorly managed. The issue is that the combination of concentration, interconnectedness, and the mismatch between individual incentive horizons and systemic risk horizons that contributed to the destruction of the Medici has appeared again within an institution that is 20 times more significant to the global financial system than the Medici ever were to Europe. In November of 1494, Medici managers wrote letters explaining what had taken place. Those letters were precise. They were accurate. They arrived after the critical moment had already passed. Giovanni Tornabuoni did not believe that by transforming the Rome branch into the most profitable operation in the network, he was also helping create the circumstances that would eventually destroy it. Each decision made sense on its own. Taken together, the outcome was different. That is how structural crises develop. They do not emerge from a chain of obviously reckless choices. They emerge from decisions that appear reasonable individually, yet whose combined weight remains hidden until changing external conditions remove the support that had been holding everything together. The Medici Bank became so essential to European finance that a slow failure was no longer possible. When the collapse finally came, it arrived all at once. With every emergency acquisition, Jpmorgan has become more deeply embedded in the structure of American finance. The question remains unresolved. At what point does an institution become so large that even a coordinated rescue cannot be organized? And if that moment ever arrives, what would that weekend look like? If this analysis gave you a new perspective, share your thoughts and continue the discussion. The strongest arguments are often the ones that force us to examine the structure before the outcome becomes obvious.